A wonderful day to you all. Welcome to Nifty Sense. Before we peel back the layers of today's market, let me ask you a question that might seem unrelated, but holds the key to everything you saw on your screens today. If you knew a massive storm was coming on Sunday, would you go out and buy a new car on Friday? Or would you pull your shutters down and wait? Today, the Indian markets essentially, quote, pulled down the shutters. While the indices didn't collapse, they retreated with a calculated caution that suggests the hidden narrative isn't about weakness, but about ammunition preservation. Everyone is looking at the union budget on February 1st, and the big players are clearing their desks. The closing pulse, the 30th of January 2026. The market closed the first month of 2026 on a somber note, snapping a three-day winning streak. Nifty 50 to 25,320.65, filled down pointing triangle 98 points, 0.39%. Sensex 82,269.78, filled down pointing triangle 297.0.36%. While the frontline indices looked pale, the small cap 250 index actually bucked the trend, soaring 1.25%. This tells us that while the elephants, large caps, were resting, the cheetahs, small caps, were still hunting for specific opportunities. Top 10 impactful headlines. Budget eve anxiety. Investors are de-risking ahead of the Union Budget 2026, February 1st, fearing lack of consumption-boosting measures. Rupee at record low. The Indian rupee hit an all-time low of 91.98 per dollar, a 2.3% slide in January alone. Metal meltdown. Nifty Metal crashed over 5% today, following a global retreat in base metal prices and profit booking. Trump's tariff shadows. Renewed fears of tariff weaponization by the U.S. administration are weighing on export-oriented sectors. Jefferies trims India. Chris Wood of Jefferies reportedly cut India's weightage in his portfolio, dampening institutional sentiment. Vedanta's paradox. Despite record quarterly EBITDA, Vedanta shares slid 8% as the street focused on near-term upside limits. Swiggy's widening losses. Swiggy reported a wider net loss of 1,065 crore rupees, dragging down the sentiment for new-age tech stocks. Paytm's turnaround. In a rare bright spot, Paytm posted a profit of 225 crore rupees versus a loss last year, showing operational maturity. Ola's lean move. Ola Electric announced a 5% workforce layoff to move toward automation and profitability. Sunday special. NSE/BSE will hold a special trading session this Sunday, February 1st, to react live to the budget announcements. Top 3 gaining sectors. Media, plus 1.2%, driven by specific corporate restructuring news. FMCG, plus 1.1%. Investors hid in defensives like Nestlé and ITC. Consumer durables, plus 1.0%. Anticipation of pro-middle-class budget moves. Top 3 losing sectors. Metal, minus 5.21%. A massive correction in Hindalco and Tata Steel. IT, minus 1.03%. Global growth concerns and U.S. bond yield spikes. Banking, minus 0.58%. Profit booking in ICICI and HDFC Bank. Institutional flows, FII and DII. FII, foreign institutional investors. Net sellers of 2,251.40 crore rupees. DII, domestic institutional investors. Net buyers of 1,650.40 crore rupees. The strategy analogy. Think of FIIs as global tourists who are packing their bags because they aren't sure of the local weather. DIIs are the local residents who are buying the property the tourists are leaving behind because they know the long-term value of the neighborhood. Market breakdown. The cause and effect logic. Why did the market move the way it did? To understand this, let's look at U.S. bond yields and tariff logic. When U.S. bond yields rise, it's like the Bank of the World, offering higher interest on a savings account. Global investors, FIIs, take their money out of riskier shops, emerging markets like India, and put it back into the safe U.S. account. Combine this with the rupee's weakness. Imagine you are a fruit seller. If the cost of the plastic bags you use, the dollar, doubles, you have to charge more for your fruit, or you make less profit. A weak rupee makes our imports, like crude oil, more expensive, which is why the market feels inflationary pressure. Green flag deep dive. 2 potential stocks. 1. Nestlé India, the defensive fortress, relative strength. While the index was red, Nestlé surged 3.46%. Value moat. Nestlé is what we call an essential bridge. Even if the economy slows down, people don't stop buying milk or noodles. Today, we saw a massive institutional footprint here, as big funds moved their money out of volatile metals, and into the business insurance, that is, FMCG. Their order books remain robust, with a focus on premiumization. 2. Apollo Hospitals, the infrastructure of health, relative strength, gained 2.19% in a falling market. Value moat, with occupancy rates hitting new peaks and a digital push through Apollo 24/7, the company has created a structural moat. Institutional data shows quiet accumulation zones being formed by DIIs who view healthcare as a non-discretionary spend, meaning it's a service people must use regardless of the budget. The dark horse, the media sector. While everyone was mourning the metal crash, the media sector showed unusual resilience, gaining over 1.2%. This is a quiet accumulation play. As digital advertising rebounds and consolidation in the Indian TV space nears completion, the smart money is positioning itself for a turnaround. It's a classic case of the market ignoring a sector until it suddenly gallops. In the current landscape of the Indian economy, one entity stands out for its monumental scale, financial health, and strategic importance to national development. Larsen & Toubro, L&T. As we enter 2026, L&T has transitioned from a traditional construction company into a high-tech engineering and technology conglomerate. Below is a comprehensive thesis on why its fundamentals are considered among the strongest in the capital goods sector. The thesis: Larsen & Toubro, L&T 1. The power of the order book. An order book represents future revenue visibility. It is the most critical metric for an engineering company, and L&T's current position is historic. Record milestone. As of January 2026, L&T's consolidated order book has surpassed 7.33 lakh rupees crore, $7.33 trillion. Revenue visibility. This backlog is approximately 3.9 times its annual revenue, meaning the company has secured work for the next 3 to 4 years, regardless of new contracts. Diversification. The orders are not concentrated in one area. They span across infrastructure, 58%, roads, bridges, and tunnels. Energy, 34%, hydrocarbon, green hydrogen, and thermal power. High-tech manufacturing, defense systems, and aerospace. Cash flow and liquidity. A massive order book is useless without the cash to execute it. L&T maintains a net working capital. The company has successfully reduced its net working capital to revenue ratio to 8.2%, down from 12.7% in previous years. This indicates a highly efficient cycle of turning projects into cash. Cash reserves. L&T consistently generates positive free cash flow (FCF), allowing it to pay dividends regularly and invest in sunrise sectors like green hydrogen and semiconductors without taking on heavy debt. Fundamental health metrics. The core financial ratios of the company suggest high operational efficiency and management quality. Return on equity, ROE, approximately 16.5%, reflects effective use of shareholder capital. PAT growth, Q3 FY26, plus 31% YoY. Profit growth is outstripping revenue growth, showing margin expansion. Debt to equity, healthy/stable. Most debt is seated in its finance subsidiary, leaving the core engineering business lean. Promoter holding 0.00%. Institutional. L&T is a professionally managed company with no promoter. It is owned by financial institutions and employees. Reasoning. Why now? The instructional flow for L&T is currently benefiting from 3 major structural shifts in the Indian economy. Government capex. The Union Budget 2026-27 continues to prioritize infrastructure, with capital expenditure expected to rise by another 10 to 15%. L&T is the primary beneficiary of these large-scale government outlays. Private capex revival. For the first time in a decade, private companies are beginning to build new factories and plants, contributing to 60% of L&T's domestic order inflows. Middle East boom. High oil prices have led to a massive infrastructure push in the GCC, Saudi Arabia, UAE, where L&T has secured ultra-mega orders in the hydrocarbon and renewable energy space. Thesis summary. L&T is not just a stock, it is a proxy for India's GDP growth. Its ability to maintain a 7.33 trillion rupees order book while increasing its profit margins by 31% demonstrates a rare combination of scale and agility. Conclusion. The wealth preservation lesson. Today's lesson is simple. Volatility is the price you pay for admission to the wealth-building theater. When you see a metal meltdown or a budget correction, don't see it as a loss. See it as a repricing of risk. Wealth preservation isn't about being right 100% of the time. It's about ensuring that when the market pulls the shutters, you have enough cash, ammunition, to buy the quality assets that others are forced to sell. Stay disciplined. The budget is just one day. Your financial journey is a lifetime.